But first, the top story tonight, and yet another reform that will help to breathe life into the economy. An economy which, by the government's own admission yesterday, is headed for the worst year of growth in a decade. Today, the Loksabha passed the banking bill. It will now move to the Rajya Sabha for voting on Thursday. Abhijit standing by with more on that. Abhijit, a significant reform. And before I come to you, actually, let me play out the comment by Finance Minister before the bill was passed in Lok Sabha today.
Most of the provisions of the bill are intended to strengthen the regulator. Capital now can be infused by rights issues, bonus shares, etc., so that every accepted mode of raising capital without diluting the public sector character of the banks can be employed, and banks will get more capital. Government is committed to infusing more capital. RBI will continue to regulate the banking sector as far as the banking regulation is concerned. The Competition Commission will also regulate anti-competitive practices and would have to approve any merger. Not one of our banks is among the top 20 banks of the world. China has 3. Not one of our banks is among the top 20. Today, if a loan size is about, say, 6,000 crore, there is not a single bank which can take the portfolio on its book. It has to put together a consortium. India, for the size of its GDP, for the future that we envision, we need world-sized banks. We said we need 2 or 3 world-sized banks. And 2 or 3 world-sized banks will come by some smaller banks consolidating with the larger banks of this country. But we will still have over 20 public sector banks, and each one of them will grow.
Abhijit, the Finance Minister really pushing ahead that reform today, as we just saw as well. He was very clear that it was critical to get this bill passed through in this session of Parliament.
Absolutely. I think, the basic philosophy here of the Finance Minister is to ensure that the Indian banking space grows and thrives, and one of the ways that he believes that can be done is to ensure there's more competition, and therefore you need more banking licenses, more players to come into the sector. But remember, the RBI and the Finance Ministry have been at loggerheads on this very issue. The Finance Ministry had actually almost directed the RBI to go ahead and proceed with the process of issuing bank licenses, but the RBI had actually stuck to its ground and said that, look, unless you give me the enabling legislation, unless you give me more teeth, I can't do that. Now, this particular legislation does just that. It gives the RBI more teeth. One of the powers that this legislation gives to the RBI is the power of supersession of bank boards for at least a period of 12 months. If that happens, it gives a little bit of comfort to the RBI that yes, it can overrule commercial boards if the bank indulges in malpractices. Therefore, when you're talking about issuing of licenses to corporate entities who are interested, who are in the wings and interested in a banking license, this is something that the regulator would naturally want. And by doing this, perhaps today, and this is where the urgency came from, you've actually paved the way for issuing new banking licenses, which is something that most of our experts on our earlier shows had actually echoed. So yes, landmark in that sense. Also the fact that there has been some sort of upgradation of the voting rights in sync with the FDI stakes in both private banks as well as PSU banks. So in that sense, these have made the banking laws a little more contemporary and in sync with our times today.
Right, Abhijit, thanks so much for joining us with that. We did get a host of reactions for you. Let's play some of these out.
Going forward, I think RBI has already issued a discussion paper, thereafter followed up with the guidelines inviting comments, and those comments have been already put on the public visibility. So it's a question now of RBI, how far it is ready in terms of issuing the final guidelines, and then taking it forward. I would guess that given that there is sufficient time that has elapsed since the issue of the draft guidelines, I'm sure the RBI would have put its thoughts together in how to take this forward.
It's not a very earth-shaking sort of banking amendment bill. There are many others, I think, areas which are really waiting for reforms in the banking sector. But the one relating to increasing the voting power of shareholders, which is an improvement from the current cap that they have. The second, of course, a very significant amendment is the role of the Competition Commission on bank mergers and all. And thirdly, of course, is which RBI has been waiting for processing new cases of bank licensing, giving it extra power to supersede bank boards and things of that type. So it should pave the way if that is what was holding up the issue of new bank licenses, I would say.
I do think that the forward market regulator needs to be strengthened much further. With the introduction of the commodity markets, particularly commodity futures markets, the huge opportunities for arbitrage, for investment, for options, etc. has opened up. And it's very important that that regulator obtains the kind of teeth that SEBI has. So I do feel that perhaps it's a bit too premature to have that kind of a clause in the Act now. So I think it's better to sit and wait before that opportunity is given in the commodity markets.
As far as RBI is concerned, they have deliberated a lot on this issue. They have come out with the draft guidelines. They've had the discussion paper out. They've had a lot of discussions with potential applicants as well as other stakeholders. So I do not expect that there should be delay on their part. Having said that, the process is a long one, and under the best of circumstances, granting of a bank license is not a shortcut. And under the current circumstances, where the list of potential applicants seem to be growing every day, I think it will be a time-taking exercise. So I'm not seeing new banks very quickly, but yes, it's a great step forward.
You know, after 2006, 2007, particularly in the backdrop of Bank of Rajasthan, it was becoming very critical that the regulator would have the necessary powers, to really regulate the sector, and make sure that there are no systemic issues. Those powers are well now provided in the new amendment, and so to that extent, the regulator is far more well equipped. I mean, he's got far more powers. He's empowered to really do all that.
Now, the other big story we're tracking tonight, the Reserve Bank of India did not oblige with a rate cut today as was expected. There was no cut in cash reserve ratio either, but it has held that there is a chance of a larger than estimated rate cut come January. Also indicating a change in stance, the central bank said that the policy emphasis would now shift to growth. Here's what the RBI's Deputy Governor Subir Gokarn had to say post that announcement.
We've seen the shift in the policy stance going back to April when we actually cut rates. So that was a tangible action that showed us shift in the policy stance. After that, we have been watching and reacting to the way that the inflation trajectory has evolved. So there was a time in between April and now when it showed signs of rising again, which caused us some concern, and so we didn't continue. And now we are seeing the trajectory starting to move down again, and that is giving us some visibility of moving more towards the growth side of the equation. That is the signal we gave the guidance we gave in October, and we've reinforced that guidance in this mid-quarter review as well.
Diana joins us for more on this. Diana, the RBI hinting at a shift in stance, moving more towards pro-growth measures. Today, of course, adopting a wait-and-watch approach. Just run us through some of the rationale behind their move. What was the logic they really gave?
Well, clearly the Reserve Bank of India's rationale rather was the fact that liquidity continues to remain under manageable level, and because of which they did not go with the CRR cut. In fact, they indicated on the liquidity front at least that the overall high balances that the government is holding with the Reserve Bank of India is leading to some amount of high deficit. This could be an indication that they are probably expecting the government possibly in the next 2 weeks or so to release some of those funds in the form of spending which will come into the system, and because of which the liquidity deficit will ease off, and that was the reason why they did not go in for a CRR cut. At the same time, they will possibly continue with the open market operations that they have been doing in the last 2 weeks. So they've already done 23,000 crores and they possibly continue with that. On the overall stance going forward, well, clearly the indication now is that they're shifting their policy stance. They're shifting to support growth. They've in fact said that monetary policy has to shift focus now, and considering the fact that inflation in the last 2 months has come in below the projected levels that the Reserve Bank of India had, they're saying that the recent inflation numbers have reinforced their October guidance. That means that they will go in to start policy easing come January, that is between the Jan to March quarter.
Thanks, Diana. Now, Commenting on the mid-quarter review, the government's chief economic advisor Raghuram Rajan said he would look forward to good news of the policy easing in January.
I think it's good that RBI sees that there is room to ease, and I mean, clearly they're taking a decision keeping in mind that their main job is combating inflation, but also they have some sort of incentive to see growth in the country. So, I think it's good news that they see the possibility of cutting interest rates going forward. So that's I look for the good news in the policy.
Let's also get you some more reactions. Commerce Minister Anand Sharma and also Montek Singh Ahluwalia talking about the move today. Dr. Ahluwalia saying that an interest rate cut was definitely needed in order to boost growth.
Of course, over a longer term, I mean, it's also important to take a number of steps that will bring interest rates down, especially since inflation is now coming down. But you know, the whole point of having a Reserve Bank that looks at these things independently is that we should give them the freedom to decide what they have to do.
It's not a very encouraging signal. RBI is autonomous, they make their decisions. But since there has been a downward trend of inflation and the capital formation is not taking place, which is directly linked to the employment creation, availability of credit to the industry at affordable prices is a must.
Well, the RBI's review today follows a rare confluence of good news. The October IIP, which showed signs of an upswing, inflation, which eased to a 10-month low, but yet the central bank still opted not to cut rates, instead waiting to win its decisive battle against inflation. Joining us on the show tonight from Washington, Jahangir Aziz, Chief Economist at JP Morgan, Mr. Batra, Managing Director at IDBI Bank, and Mr. Mohanty of Gammon Infra. Jahangir, let me come across to you first and get a perspective from you on this. Good news aside, we just had a government which slashed the growth forecast by 2% just yesterday. Is the RBI, should the RBI really have gone ahead and taken a more aggressive stance today?
No, I don't think so. I mean, look, the RBI had itself reduced its own growth forecast before that. I think the government's growth forecast is still ahead of many of ours. We are at 5.2%. The government forecast, if it actually is achieved, will require a significant improvement in the growth trajectory in the second half. We haven't really seen any real signs of that. Inflation has come down in the last 2 months, but remember, this could simply be a statistical artifact. We've seen inflation numbers being revised up. September inflation is actually at 8.1%, and we could easily see the 7.2% being revised up to 7.7, 7.8%. My sense is that I think the RBI will have to wait through all of these statistical anomalies to play out to actually get a sense whether core inflation, which is what RBI is really after, actually has gone down because of all the increases in interest rates and the tightening measures that is taken over the last 18 months, and then decide in January whether or not it is ready to ease interest rates. So by and large, I think this policy move of holding back interest rate cut for this round, I think was the right decision to do.
But Jahangir, how critical is a rate cut at this point if core inflation, as you're saying, hasn't really eased off to the extent that you know all these policymakers are betting on? We may not even then see a rate cut coming in Jan, and I mean everyone's really betting on that. All brokerages have gone ahead and said now we're going to see an even bigger rate cut coming up in Jan. You know, anticipation is building up, expectations are building up. How crucial is that rate cut really to get growth going?
Look, I mean, one has to, clarify the rate cut is important for which market? Is it for asset market or is it for the real economy? I'm sure the asset markets will love a rate cut. The question is, if 150 basis points of lower interest rate was all that stood between India and 9% growth rate, I think the RBI would have done that long time back. RBI has said that repeatedly, and many of us have echoed that sentiment that interest rate or high funding costs isn't the binding constraint to the languishing investment cycle. Hasn't been for the last 18 months, isn't right now. So my sense is that, we might be piling on RBI for, asking them for a rate cut, saying that the real economy really needs a rate cut to get the investment cycle going. The reality is that it isn't really going to do very much to investment cycle. It is going to do a lot for the asset market. That's a separate question altogether, but not very much for the investment cycle. Ultimately, it remains a government of India problem. The government of India has, and it has started on a reform blitz in September. It's actually going on with some very important reforms as we speak. But that's where the problem lies. If they're able to change investor sentiment, and by investment sentiment I mean corporate in India's sentiment, significantly, I think that's what's going to turn around the investment cycle. It isn't going to be a 25 or 50 basis points of rate cut.
Absolutely, Jahangir, valid point there. And in fact, as we are speaking, the company's bill is being discussed in the Loksabha. In fact, the session been extended for another hour there. The government clearly is on reform overdrive. Jahangir, while we're on that topic, also want to get a sense from you on how close so far you feel the government is to achieving their fiscal deficit target. It looks like it's going to be a real uphill task. And the reason I'm asking you this as part of this discussion is also because overall, while the government seems to be doing all it can to get the wheels turning, it seems that on the ground, the real figures are still far from what they would like them to be all around.
Look, I mean, we still believe that it's going to be probably around 5.5, 5.6%, 5.3% fiscal deficit target. It still looks like a very tall order. The revenue growth numbers aren't just there to deliver a 5.3% fiscal deficit. The government could pull some rabbits out of its hat by doing significantly more on the minority stake sales of the holdings that it has. That could ease it a bit. But again, 5.3 looks like a difficult number to achieve. But my sense is that even if they manage to make it to 5.5, I think even that would be a big relief because at one point it looked as if it was headed to a 6%. So I would think that I know we would be pretty much happy if the government managed to do a 5.5% fiscal deficit by the end of this year. The important thing now is what will FY14 look like. We just have 3 months left for the year for the fiscal year to get over. So FY14 is really where all our attention should be placed on. If FY14 fiscal deficit target is not credible, I think then we will find it very difficult to get investor sentiment again, backing up growth, backing up a turnaround in investment cycle. So it's really down to a credible FY14 fiscal deficit target.
Jahangir, is about an estimate of a 5.5% growth something that we should be happy with at this point of time?
I think we really, I'm sure that anything less than 9% will make us very unhappy. But 9% is too far away. I'm not really sure that we should be happy with 5.5%. But look, 5.5% growth rate is something that we can live by. Probably as long as we do that 5.5% is along with a modest, at least, turnaround in corporate investment. I think the problem really is not the 5.5% growth number. The 5.5% number could be 6.5, could be 7. If all of that is driven by higher government consumption, then it's essentially meaningless. I think what really is critical at this point in time is that after 3 years of languishing, the corporate investment really needs to show some signs of life. And I think that's essentially what we're looking for. So, 5.5% growth rate with a modest turnaround in corporate investment, I'll take that.
I think so would a lot of the corporates as well. Jahangir, thanks so much for joining us on the show. Pleasure as always. Have a great day ahead. And one of the corporates